Hey guys, welcome back. We're going to now tackle the third item, which is Unit 7, tax. Now, as I said a little bit earlier, tax is a very, very complex, subject. So let's talk about a couple of the principles. So it's very complex. It's dynamic, and by dynamic, I mean it changes continuously. It changes every year. It changes through the year. When the Minister of Finance gives his budget speech at the beginning of each year, you'll notice that he comes up with a number of changes. Okay, so there are changes happening all the time to tax legislation. And what's also very important, certain cases, tax cases, are used as precedents. And that's basically how tax issues are argued. They look at past cases, and they use that as a precedent to argue the next case. Okay, so if you are particularly, or you're concerned about a tax issue you have and you want to take it to court, you would nominate a legal representation, and they will take you to court, and they will use precedents to argue your case. They'll look at a similar case that happened, and they'll look at the outcome of that case, and they'll argue in favor of your particular situation. Okay, so tax is very complex. It's dynamic. It's changing all the time, and in tax they use precedents or past cases to argue present cases. Okay. Now, what you get direct taxes and you get indirect taxes. Now, direct taxes are basically individual and corporate tax. In other words, income tax. Okay? Indirect taxes are basically the rest. Things like VAT, transfer duties, toll fees on the roads, tax on fuel, it's indirect, excise duties at the borders, etc. Okay, so direct taxes are mostly income tax, indirect taxes generally the rest. Okay, and then you might ask, why do we get taxed? Why do we have this tax? Why do we have tax legislation, and why are we all subject to tax? And it's basically to pay for public services. Okay, often the funds are used for redistribution. Okay, from wealthy communities to poorer communities. The monies are often used to promote business and business development and employment. So, for example, if you take a lot of our students in the full-time class are from the Eastern Cape. And if you look at the Eastern Cape has got a very, very, very substantial motor business. And that was created, I think, back in around about the 70s, when the government decided they wanted to develop the Eastern Cape into, with some sort of manufacturing field. And they chose the motor industry. And they said to the motor industry, if you concentrate your businesses down there, you'll get certain tax credits or tax breaks. So the likes of VW, Mercedes, I think Opel was down there as well, no longer there now. Isuzu as well. Isuzu's down there. I see there are quite a few Chinese companies now too, at that big port infrastructure. There are a couple of Chinese companies there that have set up. So with that then came not only the manufacturing plants, but all the plants that assist with the manufacturing. So what you have in a lot of these plants is what they call just-in-time, JIT. Now, just-in-time means that, and it was actually designed by the Japanese, that when you've got a manufacturing plant and a process, that when you need the product, it'll arrive just in time. So in other words, if you think about a motor car going through a process, that you need the chassis. So you don't actually manufacture the chassis yourself. It's done by an ancillary business down the road, and just when you need it, it arrives. And the panels arrive just in time. And so do the wheels and tires and battery and engine, etc., etc. So what you have is you have a manufacturing plant like VW, and then you have all these ancillary plants around there which are providing labor to a lot of people, okay, employment to a lot of people that build and provide the all the pieces that go into the motor car. So some is important, a certain element is imported, but a lot of it is actually homegrown, manufactured in South Africa. And I think that the South African government might have specifications in terms of what percentage of input has got to be locally manufactured. So promoting business and employment, and we saw that in the Eastern Cape. There are certain other areas in the country that's happened as well. I think that what's developed in the Western Cape are things like the film industry, and now more recently the IT industry. Okay. And then obviously the last thing that governments use this funding for is to further political goals. Okay, they might be positive in some eyes, they might be negative in other eyes. Okay. So that's why we all get taxed. So yeah, just remember it's a very complex subject. People spend years and years studying it. It's dynamic, it's changing all the time. And we use these precedents. You'll see them, and if you've got the book, you'll see they give examples of precedents, the cases that happened in the past that had a result, and they use those to argue other cases. Okay. So we're going to look at a couple of different types of tax. We're not going to look at all the taxes. We're going to look at income tax. We're going to look at VAT. We're going to look at capital gains tax. So we're going to look at these fairly quickly, these two. We're going to spend a bit of time on capital gains tax, okay, because capital gains tax is a little bit more complex. Then we're going to look at local authority taxes, which are basically rates in most municipalities, rates. And then we're going to look at transfer duties. And we're going to do a couple of calculations in transfer duties. Okay. Okay, so first off, let's look at income tax. Now, whether you like it or not, if you are earning an income, you will pay. You will be subject. I'm not saying you will pay. You will be subject to income tax. Okay, so if you're earning an income, either fully employed, employed under contract, or working as a consultant, if you have property and you're renting the property for gain, you will be subject to income tax. You won't necessarily pay income tax because you'll have certain expenses that you can offset against your income. You will be subject to income tax. Okay, so they'll look at your income, and then you can offset certain expenses against that income. But the expenses must be related to deriving that income. So, for example, if you've got a property, certain expenses are deductible, like repairs and maintenance, for example. Rates, they're deductible as an expense. If you're running a bank account, especially for that particular entity or that property, that the costs of running that bank account are also tax deductible. And so are interest payments. So if you've got a loan that you're repaying, the interest part of the repayment, not the capital obviously, but the interest part is tax deductible. Okay. Now, very important with tax, income tax, is to decide or to distinguish between whether it's of a capital nature or a revenue nature. If it's of a revenue nature, it's subject to income tax. If it's of a capital nature, it's subject to capital gains tax. Okay, so it's important that you distinguish that up front. When you're disposing of a property, that's obviously of a capital nature. Okay. If you are renting a property, that income is of a revenue nature. Okay. The problems arise when the intention of the taxpayer changes during the course of the ownership of that property. For example, a person might own a piece of land, and there might be no revenue on that land, and that person might be intending to hold the land to make a capital gain over a period of time. Okay, so that's of a capital nature. But during that period, the investor decides to develop that land. And they develop that land and then maybe put up a student accommodation and then rent the units. Then obviously the intention has changed. Okay, so now it's gone from being only of a capital nature to a revenue and capital. Okay, and as I said, there are certain deductions that are allowed, and they've got to relate to the actual income being earned. They can't be totally unrelated. So, for example, if you've got a property that you're renting, and you're studying property economics and finance at CPUT, and you want to offset your expenses of your studies against your income that you're earning through your rental, that's not possible. Okay, there must be expenses that are directly related to maintaining that property, like repairs and maintenance, rates, interest payments on that property, not another property. Okay, so you can't say, I'll just maybe just shove the interest on my primary property. I'll also just put it in there. You know, they won't notice. They're very, very clever. They're very intelligent people. They purposely have employed chartered accountants, and I've had a couple of questions in the full-time class about whether you can do things untoward and unnoticed. You can't. It's impossible. They will. If they don't catch you this year, they're probably using AI now, artificial intelligence, and they're probably looking for trends. So the human mind can't manage as well as a computer, and can't remember facts as well as a computer can. And they'll be looking for certain bits of behavior. They'll try and identify those, and they'll pick them out. And if they don't catch you this year, they'll catch you 1 year. And when they catch you 1 year, they'll go back to all the other years, and they will penalize you for the other years. So it's actually not worth it. This one guy was saying to me in class, so what if I get, I don't know where he got this amount from, 500,000 Rand paid into my account to buy this property, and then I buy it. He had this whole story. And I said, well, first off, any amount more than 5,000 Rand deposited into your bank account has to be reported by the bank to the Reserve Bank. So they're already looking at you. As that money arrives in your account, if it's coming from overseas, then doesn't matter what the amount is, they're already looking at you. So, or they've got an account of you. So, no, you can't pull the wool over their eyes. Okay. Then, obviously, it depends on what the structure of your entity is, or what type of entity you chose to register this property. Okay. And what the relative or relevant income tax or tax rate is that you'll pay on this property. So for an individual, the top rate that you'll pay now is 45%. Obviously, it's a rate that increases depending on your earnings, but the top rate is now 45%. I think I've got it somewhere where at what level you achieve that. I might have that somewhere here. Can't remember now. Then company tax is currently 28%. Company tax is currently 28%. And tax on trusts is the same as an individual, but it's a flat rate of 45%. Okay. So the marginal tax rate of an individual is 45%. Fixed rate on companies is 28%, and then family trusts is a fixed rate of 45%. Okay. Okay, then as I said a little earlier, that if you transfer a property from one entity to another, not from one entity to another, there is a transfer duty applicable. But if you change the shareholders and you maintain it as a going concern, then you will not be subject to that transfer tax. Okay. The next one is VAT. So, if you are a developer, you would normally get registered as a VAT vendor, and when you sell the properties, VAT would be levied. Okay, there's no transfer duty on first-time sales. And there's no transfer duty levied on first-time sales. You'll pay VAT. And the way VAT works, do you understand how VAT works? Value-added tax, unlike GST. So we used to have a form of tax they called general sales tax. We used to have, it was called general sales tax. And general sales tax really was a tax that was applied to the final sale of an item. Okay. The problem was this, is that if a product is developed and eventually doesn't get sold to a private individual or a company at the end, it can actually avoid this type of tax. So what they were using, they developed overseas, and what we now use is what they call VAT, value-added tax. So if you think about production process, so you'd acquire the raw materials, and when you acquire the raw materials, you buy them from a supplier, you'd pay a 15% VAT on that. Okay, so you'd be subject to 15% VAT, okay, when you buy the raw materials. Okay. And the VAT would be paid to the provider or the seller. Okay. And then you would, maybe in the process, you develop those raw materials. Say, for example, you are a business that makes body parts for a motor car. So when you sell those body parts to, say, you manufacture body parts and you sell those body parts on, say you sell them onto a painter or a paint organization that does the painting. Okay, so then they would pay, the painting organization would pay 15% VAT on the body parts they bought from you. Then the painter, so say the painter then paints those body parts and then sells them onto onto VW for manufacture. So VW would pay 15% on that, and when VW sells the car to the end user, to the consumer, there's a 15% VAT there too. Now what happens is that along the line, the receiver is now guaranteed it's going to receive tax at every single point. Okay, but what you can do as the painter, you've paid 15% VAT on the body parts. You can claim that as a credit, because all the receiver is interested in is this final amount here, and he gives credit for all the other amounts that are gathered. Okay, so all these 15% are gathered. He's only really worried. The receiver's only really worried about this very last one here, because say for example the car is sold for 200,000 rand. Okay, so he's getting VAT on that, but he's got VAT on every single one of the other levels as well. So he's getting his VAT on 200,000 rand. He actually then gives credit for all these 15% going along the line here too. So provided these individuals or these companies are registered as VAT vendors, they can recover the 15% they paid as a credit. Okay. So this is the person that eventually pays the VAT, the consumer right at the end. They eventually pay the VAT, and the rest are credited with the 15% they paid along the line. That's how VAT works. And it just ensures that if we never get down to this level over here, that the government has got its 15% somewhere along the line. So if, for example, the car is never sold, VW has paid 15% on, say the VW paid say the cost for, final cost for VW was 150,000 Rand, okay? They would have paid VAT on 150,000 Rand to develop the motor car, and they were hoping to make a profit of 50 when they sold it to the end consumer. So the car is never sold, then at least the receiver has VAT on 150,000 Rand. Okay, and the rest can get their credits back, but VW cannot get their credit until they've sold the motor car. Okay, so going into another financial period or tax period, the VW will not be able to recover that money if the car is not sold. Okay. So that's how VAT works.
Just a quick one.
Yeah.
People that come from across the borders,
Yeah.
into stuff here, many times when they get to the border gates and whatever, they declare what they bought.
Yeah.
I think somehow they can finance some stuff.
They get their the VAT recovered. Yeah. So if you travel, in some countries, I wouldn't say all the countries, but some countries you can, once you get to the airport or the port, you can, provided you've kept your slips, and provided it's beyond a certain amount, because there's obviously an admin cost to doing this thing. So you'll only be able to recover monies if you spent in excess of a certain amount of money. You'll be able to recover the VAT that you spent on the money. But what you will do is you should declare that when you go into your own country. You should declare those purchases, and you'll pay VAT, you'll pay tax when you come into your own country. So what you should be doing is you should be recovering. Say, for example, you went to France or the UK on holiday, and you bought €1,000 worth of stuff. You got back to the airport in Paris, and before you flew back, you went and got your tax credit. And they gave it to you. When you arrive at the airport here in South Africa, when you arrive there, there's some guys down there. You got the red and the green light. You go to the red light. You must go and declare what you've bought, because he's going to tax you. So the foreigners know that you're going to pay VAT there, but they don't want to penalize you twice, because they know you're going to pay tax on this side too, this import duties. So what they do is they give you a credit on that side, and then when you come this side, then you'll pay tax. But it's only on a certain amount. I mean, the South African government every country allows you a certain amount of imports without paying tax. But once you go beyond that, I don't know what the limit is. Is it 1,000 Rand or 2,000 Rand? Or maybe it's more now. I don't even know what it is anymore. Anything over that, you are subject to import tax. Okay, and that's why they give you the credit on the border, wherever you are. Okay. Okay, so the sale of sectional title units or timeshare units by a vendor is subject to VAT. So when they sell it to a consumer, then the consumer will pay VAT. Okay, and then any VAT that they've paid, that the vendors paid, they will get credits on those amounts paid from the receiver. So when every 2 months they lodge a VAT return, and in that return they'll have all the VAT that they've paid and the VAT they received, and they'll offset the one against the other. Okay. And then there's a story about the property disposed of as a going concern. The sale will be zero rated from a VAT perspective. So there you have to make application to have it zero rated. It's not automatically zero rated. So there the implications are that VAT is not payable, and then you're also exempt from transfer duties. But it must carry on a similar business. There are the requirements actually set out there. Both entities must be carrying on the business prior to and after the sale. The sale agreement must contain a statement to the effect that both parties are going concerns, and the sale is between two registered vendors, and the VAT numbers must be inserted, and the property being sold is capable of being utilized and is currently utilized to earn taxable income for VAT purposes. Okay, so there are a whole lot of requirements here. It's not just a simple thing. Okay, so it just talks, in the notes, we just talk a little bit more about the different services that might be supplied in the maintenance and the construction of properties, and the VATs that are levied on those, and the VATs that are eventually received from the consumer at the end of the day. Okay. What is more important, what is more complicated, is capital gains tax. Okay, so let's have a look at capital gains tax. So it's important to know that capital gains tax was introduced into this country on 1 October 2001. Okay, it's quite an important date. And its intention was to levy a tax on profits made on assets. So it's not only on property, it's also on shares, it's on any asset. If you're a collector of motor cars, old motor cars, and you sell a motor car and you make a capital gain, you're subject to capital gains tax. It's the same would happen with jewelry, for example. If you're a collector of watches or jewelry, the same thing. Any gain you make in terms of a capital nature will be subject to this capital gains tax. And it involves both movable and immovable property. Immovable property being land and buildings, and movable being any other item. Okay. And capital gains tax is payable in respect of South African residents worldwide. Okay, they're worldwide assets, which is not the same as income tax. Income tax currently is only on your earnings within the borders. And a lot of people do work overseas. If you work overseas, you're normally subject to the domicile in which you're working. You're normally subject to their tax. Some of the places like the Middle East, I believe there's no tax for foreigners. So at the moment, in terms of income tax, you only taxed in terms of your income that you earn within the borders. It is changing on 1 March 2020. The receiver now is going to change the law, and you will be taxed on your world earnings from 1 March 2020. So that's next year. Okay. So everyone is getting very nervous about this. Being a lot written in the press about it, or a lot written, I've seen on News 24, articles written about this, that people must start getting ready, because there are a lot of people that are working offshore and remitting their funds back to South Africa and not paying tax on them.
So, in that case, you pay tax in the country you're working, and then when you bring it to South Africa,
So there won't be a double tax. So if you're paying tax in the foreign country, then you will pay the difference in South Africa. Yeah. So you'll get taxed. Say, for example, their tax rate is 10%, or say it's 15%, and here it's 45%. You'll pay 30 on the balance. Yeah. So what you do is, when you complete your tax return, say, for example, you've got income in the country. Okay, so you declare the income in the country. Say, for example, you've got a property that you rent. You declare that income you're earning and less your expenses. And then you also do some work overseas. You'd declare your earnings overseas, less the tax. Okay, lesser tax that you already paying. Yeah. Or you'd let them know what tax you've already paid on that income. Okay. So yeah. So this was introduced 1 October 2001, and it's payable in respect of your assets worldwide. Okay. And it's payable when there's a change of ownership, basically. Sold, given away, scrapped, swapped, lost, destroyed, etc. What's important here is that we have a base cost. Now, if you bought a property before 1 October 2001, you had to have it valued within 2 years to get some sort of valuation at the time. And then your base cost will be that valuation. If you did not do that valuation, you'll see that if you did not do that evaluation, they'll use a second one, which is a time apportioned base cost. Okay. Now, time apportioned base cost is they'll look at what you bought the property for, say, in 1995, and what you sold it for in 2015, that's a 20-year period, and they'll divide the capital gain by 20, okay, and they'll have a look at what you made every year, and they'll portion that to between 1 October 2001 and when you sold it in 2015. Do you understand that? So what they'll do is they'll take what you paid for it in 1995, they'll look at what you sold it for in 2015, so that's a 20-year period. They'll divide that capital gain by 20 years, so then they know what the gain is per year on average, and they'll apply that to 1 October 2001 to when you sold it in 2015. Okay, so that portion of the capital gain will be taxed. Okay, if you don't have that, then they will take 20% of the disposal proceeds as the base cost. So in other words, which is probably the worst, because if you sold it for, say you sold it for $1 million, they're going to take your base cost as 200,000. That means your capital gain is 800,000, which is probably not the way to go. So the best way would obviously have a market, have an agent give you a market price within those 2 years. If not, then the time apportioned base cost is probably the second best. The worst will be that 20% of disposal proceeds. Okay. They probably adjust that from year to year too. I'm sure they do. Yeah, so those important. Those three methods are very important. So you had the base cost is based on 1 October 2001, and you were required to get a valuation within 2 years. If you did not do that, then they'll apply one of those other two.
So it is your responsibility to get that.
It was, yeah. We were told, we were warned, because we bought our house in 97, I think, and we were told, and it was made public so many times. You also had a chance, by the way, in that 2-year period, to change the entity in which it was registered without paying transfer duty. And the reason why is because a lot of people registered their companies in CCs. Now, CCs don't exist anymore. I mean, the ones that do exist are still functioning, but you cannot go and register a close corporation. They were very useful because it was a very simple mechanism. It basically has the advantages of a company with not as much limited liability, though. But it has the same sort of advantages. The advantage for registering a property in a closed corporation was if you sold it, all you had to do was change the shareholders, and then there was no transfer duties payable. But the receiver soon got hold of this. As I said, you can pull the wool over his eyes for a couple of years, but he eventually gets wind of it, and he stopped that. So, and the other thing was a lot of people put register their homes in property trust in family trusts, and they also wanted them out of the family trusts. So they gave you 2 years within which to get them out of those CCs and out of the trusts, and there were no taxes payable. Okay. Yeah. Okay, so those three methods are to establish the base cost is very important. Okay. And you'll see in the notes there the different rates for capital gains. The effective rate for individuals and for special trusts. Now, special trusts are like, if you set up a special trust for somebody who's got a disability, then the effective rate is 18%. So it's 40% of the marginal rate, which is 45. So the effective maximum rate you'll pay as an individual on in terms of capital gains is 18%. But you know, the likelihood of being up there at 45, your marginal being 45, is probably quite slim. So you'll be paying a lot less than 18%. And the other thing is that for an individual, the first 2 million of a primary property is tax-free. Anything over 2 million is taxable in terms of capital gains. Okay, but a second property is fully taxable. So it depends on your marginal tax rate, but the max you'll pay is 18%. Companies, they pay effective rate of 22.4, which is 80% of 28%. Company tax is 28%. The worst one are family trusts. Their effective rate is 36%. So that's 80% of the tax rate, which is 45. So that's the worst. So you're going to get taxed a third of your capital gain if you sell a property in a family trust. Now, the interesting thing about this is when you look at tax, the very first thing I think that was put down here was that it's important to reduce your tax exposure at any point. Now, with a family trust, if you sell the property in the family trust, you'll be subject to that effective tax of 36%. If, however, you distribute the assets to the beneficiaries and then sell the property, then the beneficiaries will be paying the tax, the capital gains tax, and they'll be paying at their rate. And the maximum effective rate is personal tax is 18%. So there is a way of maybe minimizing your exposure to tax. Instead of selling the property in the family trust, what you do is you distribute the capital to the beneficiaries and then sell the property. And then the tax will get paid in the name of the beneficiaries, in those personal names. And
Can I ask you a question, buddy?
yeah,
If you have a trust,
yeah,
okay, you sell a property, but the beneficiaries of that trust are 3 other trusts.
yeah.
Can you move the money to those trusts and then from there move it again, or can you only move it once?
No, you can move it again. Yeah, sure. Yeah, but you know, if you remember, if you're still alive, it's a family trust that you set up for yourself to protect it. It's normally protection against creditors. Okay, and your beneficiaries are your children. You set it up for your children. So when you die, the assets remain intact, and then the children have the benefit going forward. There's normally an age at which the trustees can distribute the funds to the children. That age is normally 25. So they can't receive the funds before the age of 25. If you die before that age, before they reach the age of 25, then what happens is normally the trustees will manage the funds until they reach the age of 25. So the property can be disposed, or the assets can be disposed, and then the funds transferred to the beneficiaries once they reach the age of 25. Yeah. I don't know where I was going to go with that, actually. I can't think. Anyway, it'll come back to me just now. Okay, so it's very important that you minimize your exposure to tax. And there's a perfect example. You sell a property in the trust, you're subject to 36%, effective 36% tax. If you distribute the proceeds, then you'll be subject to and they individuals, they will pay the tax in their own capacities, and the maximum rate they'll pay, maximum effective rate is 18%. Okay. Yeah. There's certain exclusions from capital gains, and there's a list of them there. retirement benefits, long-term insurance, etc., etc. Personal effects. You might have a couple of personal things that you're selling on Gumtree. You know, you're not going to be subject to capital gains. But if they more valuable items like collections, car collections, watch collections, or jewelry, or you could be. And then prize money and lotteries. There's no, in fact, there's no tax on the lottery. Do you know how the lottery works? You know, if you win, and I'm not quite sure if it works the same in South Africa, but I'm sure it does. But in Europe and the States, if you win 20 million, you will not receive the 20 million in your bank account. What happens is that they, if you want the full amount up front, they will discount that over 20 years at a rate that they apply, and you will receive the discounted amount. And it normally works out at about two-thirds of what you've won. So you sort of wonder where the balance has gone to. But anyway, it's beside the point. But so if you win 20 million, you're not going to get 20 million in your bank account. What you're going to get is one of two things. They'll pay it to you over 20 years. So they'll pay you R1 million a year over 20 years. Or they'll pay you a discounted amount, which they discount over 20 years at a rate that they apply. And it's probably two-thirds or it's probably 60% of that. So it's probably 12 million. That's probably what you'll get in your bank account. I think it works the same here in South Africa, but it certainly works like that in the States and Europe. I think it forms part of your estate. Yeah, it forms part of your estate.
How true is it that the pension fund, if you die and your kids are beyond 18, then it becomes estate money?
Yeah, what you do is you when you have pension funds or life policies, you have beneficiaries. You've got to nominate beneficiaries. Don't have to be your kids. Doesn't have to be your spouse. Can be anybody. Can be the SPCA, for example. You can leave your entire estate to the SPCA or to the CPUT or whatever you like.
What I'm saying is, let's say you work till you go retirement age,
Yeah.
and then as you go retirement, you start getting a bit of cash from the fund itself.
Yeah.
If you die and all your kids are beyond 18, and you know that there's still some money remaining in the fund itself, is it something that can be given to the kids, or does it stay?
Yeah, provided they be nominated as beneficiaries. If there are no beneficiaries, and I don't think that any insurance company will allow you to have a policy without beneficiaries. If there are no beneficiaries, then it'll form part of your estate, and the process can be a long, long process. The legal process can take sometimes 2 years to resolve. And often what happens during those 2 years is that all sorts of people come out of the woodwork, and they make claims against your estate. Obviously, the first ones are normally your spouse and your children, but it can get very complex if there's more than one spouse in the past and their kids from different marriages. But generally, what you do is you nominate beneficiaries, and sometimes there are challenges. Challenges can happen, and sometimes they take it to court. But generally, I think about my mother. My mother's she continues to receive my father's pension. He passed on. So it obviously a reduced pension. It's a spouse pension, it's reduced, because now there's only one person, not two people. So those things are normally divulged to you up front when you sign the policy. Okay, so let's have a look at rates, local authority taxes. Rates. So once a year, and it's happened. In fact, it's going on at the moment. I think the different municipalities they do their assessments of the properties, and they look at different areas, and they look at the market value of properties in the area, and they normally look at properties that have sold recently. And they give you, and depending on what the size of your property is, they give your property a value. And it's fairly close. They've got fairly accurate now. They're fairly close to the market value. They used to be way off target, but they've got very, very good about it now. They're fairly close to the market value. So if you look at your rate account, you'll see there is a part of the rate account that actually states the market value of your property. There's a document, they call it the valuation roll. So then this valuation roll is compiled, and you as a homeowner or a property owner can challenge this valuation roll. If you don't believe that that the valuation is accurate, you believe it should be less, you can actually challenge it. And quite often they'll actually reduce it. If you've got a strong enough case, you can go along to in fact, you've got to go in person. You go along to the municipality and you lodge a complaint. There's a whole process you go through. You can lodge a complaint and they will have a look at your complaint and then they will adjust it accordingly. But once, yeah, there's a certain amount of time within which you can lodge that complaint. And I think it's ongoing now. I think the valuation roll was made available at most municipalities, and it's normally ongoing till 1 July, something like that. I think it's end of June or 1 July. After that, they'll become fixed, and the rates will then change, I think, from 1 July. It is 1 July. I know Joburg is 1 July. So then the rates will be changed, and you'll see there's a place on your rate account with the market value. And normally it adjusts on a yearly basis. Funny enough, it never comes down, it just goes up. And yet property is something that goes up and down all the time. Anyway, so one can argue the case. One can say, look, right now, and I'm sure in Cape Town, a lot of people have got a very strong argument for a lower market rate because the properties have come down 20-25% here so far. Okay, so they got this valuation roll. You can challenge it, and they might adjust it accordingly. Okay, and then you pay a percentage of the valuation of your property in terms of a tax, and they normally call it rates and taxes or rates. Okay, it depends on the area. It depends on how valuable land is in the area. The price is actually achieved in that area. Okay, so some areas, people might pay for a property, they might pay 10,000 Rand tax. Other places, I think in some places there's no tax. Or there might be 200 Rand tax or 500 Rand tax. Just depends on the value of the property, value of the area. I would say areas like Constantia, the areas around there, they're probably paying very, very high rates. And then you get other areas that are not, that are a little bit, where the market values are lower, they'll be paying much lower. So maybe lower Claremont, Wynberg, then going further out, probably paying, sorry? Yeah. I'm sure, look, I don't think they do. I don't know if, there is a cutoff. If they look at a value of a property, I think there's a minimum amount. Is it 500,000 or 900,000? It's a minimum amount. If they value a property at a particular level, there are no rates applicable. Okay. So there is a case of this redistribution. They take from the wealthy and they take from the wealthy and they provide services to the poorer people. Okay. So that is a strong case for redistribution. And, if you think about the services that are provided in the areas, it's normally roads, it's normally rail, it's normally sewage, water, electricity. Okay. So, So that's generally what they collect rates for, to maintain the roads in the city, not the rail, it's all railways actually. To maintain the roads, to maintain the sidewalks, to maintain the sewage system, the water system, and the electrical system. Okay, let's get to transfer duties. So, as we said, if you transfer a property from one entity to another, you're normally subject to transfer duties. Unless it's you're registered as a VAT vendor, then VAT will be applicable. But generally, if you're transferring from an individual to an individual or a company to a company, the transfer duties are applicable. So we're going to do a couple of examples here because it's quite important. There's a good chance you'll get something like this in the exam because it's quite an important exercise. Now, the table that I'm going to put up on the board is a table that's applicable right now. It's not the same table you'll see in the book. That's not important, really. If you get something like this in the exam, what you do is you'll get given the table, and you apply that table to the problem. Okay? Don't try and memorize this table, or don't try and memorize a table in the book. If you get a question like this in the exam, you will be given a table, and you will need to apply this table, or the table that you're given, to the problem at hand. Okay? So let's take this table. This is the current table. And this table, I think, changes every year. So it's just a table that's applicable right now. So let's have a look at this. So we've got the value of the property, the value, and then we've got the rate. So let's look, 0 to 900. And here you'll see what you're saying now with rates. Here in terms of transfer, this is 0. So any property that has a value, or any property that's sold whose value is less than 900,000 rand, there is no tax payable. Okay. Between 900,001 to 1250, it's 3% of the value over 900K. Okay. So the first 900 is not taxable. Anything over 900 up to this point is 3% of the value over 900. I see I've got 750. It should be 900. 1250. 1 to 175000 is a fixed amount of 10,500 plus 6% of the value above 1250. 1250. Sorry, it's getting a bit small. And then 1750,001 to 2250,000, fixed amount of 4,500 plus 8% of the value above 1750,000. And then we do 2250,001 to 10,000. That's 80,500 plus 11% above 2250,000. And then above 10 million is 933,000 plus 13% above 10 million. Okay. Okay, so that's the one that's currently in use. As I say, it changes from time to time. Okay, let's do a couple of examples so that you are familiar with this. Let's take a property that was sold for R1 million. So let's say the property was sold for R1 million. Okay. So R1 million falls into this category over here. Okay. R1 million falls into that category over there. And that category says 3% of the value over 900K. Okay. So what you do is you take the 1 million and you subtract 900K and you're left with 100K. So it says 3% of the value over, which is this. So what you do is you take 3% multiplied by 100,000, okay, which is 3,000 Rand. So that would be the transfer duty. Okay, so it says there, so R1 million would fall into this category here, and it says there's no fixed amount here, it's just 3% of the value over 900,000. So you take 1 million, you subtract 900, you're left with 100. So the 100,000 is subject to tax, okay? And it said it's 3% of that. So 3% times 100 would be 3,000 Rand. Okay, guys got it? Let's do another one.
So the transfer duties is different from the transfer fees, right? So you pay the transfer duties to the receiver, then transfer fees to the buyers.
So what happens is that normally what's involved in a property transaction are legal people. And the legal people normally affect the buy and the sell. So they bring the buyer and the seller together from a legal point of view. And they make sure that all the requirements in terms of transfer and tax are settled. Okay. And so what they would make sure that they collect this from the buyer. The buyer is the one who pays the transfer duty, okay? So they would make sure that they collect this from the buyer. They would also make sure that they collect the R1 million from the buyer. Okay, so they can pay this across to they can settle any loans and then pay the balance to the seller. Because normally there's a loan involved. So first of all, they'd have to settle the loan, and then the balance is paid to the paid to the seller. They would collect this as well. They'd pay it across to the receiver. And then the legal people would obviously charge you a fee. Sometimes there's a set fee. Sometimes it depends on the amount of work they put into this thing. Conveyancing fees, and there's also a deeds office fee, I think. So they'd have to collect that. So there's a whole lot of different fees. But they normally have contact with the receiver, with the deeds office, with the banks. They've got all those connections. So they're very good people to use. To try and do it yourself would be a bit of a nightmare. The bigger institutions like Old Mutual, Sanlam, the big property funds, they would employ people like that. Okay, so they probably wouldn't use or they'd have their own legal people in-house that would do these tasks. Because they're doing this buying and selling all the time. So they need to, they probably find it more cost-effective to employ people like that. Okay. Okay, so let's do another one. It's a fairly simple one. Let's change the selling price to, let's take 2 million. So let's say we sold the property for 2 million Rand. Okay? So we look at our table here, 2 million would fit in there. And the tax applicable would be 40,500 flat rate. Okay, so you've got to pay a flat rate of 40,500. Okay, that's what it says, 40,500 plus 8% of anything above 1,750. Okay, so we take 2 million, 1,750, and we're left with 250,000. And it says 8% of this. So we take 8% times by 250,000. See what that is.
Shouldn't you first deduct the 900?
I'll come to you now. This is 20,000. No, because we're looking at this particular category over here.
So you don't, it's not like Sulatin where you take
No,
the 900 off and then the...
no, that'd be complicated. No, it's not like that. No, the 2 million sits in this category here. In this category, you're subject to 4,500 flat, which would cover those things. You see, it would cover the 4,500 covers anything below 1,750. Okay, you can do a calculation and see what rate you're paying. But so if you took off the 900 from here, what you left with? You left with 850. What's 40? What's 45? Let's have a look here. We see what percentage that is. 4,500 divided by 850. 11.8%, 12%. So I mean, it's quite high actually. Yeah, it's quite high when you look back. Yeah, it's quite high. Okay, so it says here you take the flat rate of 4,500. Okay, you got 4,500 on the one side, and it says 8% of the difference. Okay, so we sold it for 2 million, and we've got to subtract 1,750. We get 250. So it's 8% of that, which is 20,000. So the total tax payable is 6,500. 60,500. That's the total tax payable. It's important that you know how to do these. So, and the easiest way is to actually do a couple yourself. So in your preparation for the exam, then maybe do a couple of these yourself. You know, just sit down and actually go through the process. So you're not doing it for the first time in the exam if you get one of these. Okay, let's do we'll do one more when you guys have got it down. We will do one for 12 million. Your wish has been granted, yeah. Okay, you guys finished here? Okay. Okay, so let's do one of 12 million. So we sold the property for 12 million. Okay, so that's this category down here, last one. And the tax that you're subject to is that one over there. So first off, you pay a flat amount of 933. So this is the buyer that's paying this, eh? Remember, it's the buyer who's subject to the tax. And then you're paying 13% of anything above 10. So you've got 12 million, less 10 million, is 2 million. Okay, so, and you pay 13% of 2 million, which I think is 260,000, 260,000. 260,000. So it's $1.2 million basically. It's quite frightening actually. So you buy the property for 12 million. And you've got to come up with 1.2 million tax. That's like 10%. It's hectic, eh? So, which, you know, which is not entirely a bad thing because it's you're taking from the wealthy, and hopefully the government actually uses the funds correctly and they don't finance their own projects. But yeah, so they use the funds properly and they redistribute them. It's taking from the wealthy and giving to the poor. So that's quite heavy. Yeah, it's 10% basically. Yeah.
It's quite good as it is, but it doesn't get used for such. It's the set
Well, that's another discussion, eh? Okay, so yeah, so ultimately paying 13.2 million for the property. Okay, do you think you can do these things? You can't do them. You must practice them, eh? You must practice. Okay. Okay. Okay, well, that's the end of tax. I want to go through the exam with you a little bit. And you guys are, this thing, man. You're writing on the 7th, I think. So you're writing on the 7th at 8 o'clock. So it's a Friday, 7th of June at 8 a.m. If you're choosing to write online, then it'll be made available at 8 o'clock in the morning. If you're choosing to sit, you are given the option to come to the venue, I think, if you're in Cape Town. If you're not in Cape Town, well, then you must choose. They've got venues in Pretoria, Durban, East London. Otherwise, you're welcome to do it online if you want. The exam is exactly the same. It's no different. You get the same amount of time as well. So don't feel like you'll be prejudiced if you're doing it online. Just make sure that if you're going to do it online, that's your choice, that the things we spoke about, that you have a responsibility to conduct yourself accordingly, like you would expect in an exam situation. Okay, no walking around, no talking, and concentrating on your screen as opposed to looking at anything else. But the other thing is you've got to make sure that you've got decent connectivity. It's probably the most important thing. If you don't feel secure about your connectivity, it's probably best to go to a venue.
But at the venues, they say you must bring your own.
I see so, yeah.
Yeah, so
I thought that the venue in Cape Town was for you to come along and do a physical exam. And I'm sure you'll be able to, I'm sure. I actually don't know why they said that. I'm not sure why they said that. I think they're worried about the reliability of the Wi-Fi here. I don't think it's 100% reliable. And you know, during exam time, there's just so much going on that sometimes it can fall down. It has done in the past.
Before you go further, can I just
Yeah.
verify something? Is this an open book test?
No, it's not an open book test.
Oh,
It's an exam.
I was getting back to the issue where you said you should concentrate on the screen. Makes sense.
Yeah. No, it's not an open book exam. No. Okay, so let's go through some of the details. I actually put some of the details up on Blackboard, so let's go through them in a little bit more detail. So it's a 50 mark exam, 50 marks, and you get 2 hours within which to complete it, Both of you sitting and if you do online. It's divided up into 5 sections or 5 questions. If you do it online, it's not divided in the same way. It's just like a whole lot of questions. You get question 1 to 25 or 1 to 30. If it's a physical exam, you get the paper, it's question 1 to 5, and each question has 3 or 4 subsets. One question might have 1 or 2 subsets, but so you'll get question 1 that's got A, B, C, and you might get question 2 that's got A and B. So the way the online does it is that, so it'll be in question 1, it'll be question 1, 2, 3, as opposed to question 1A, B, C. Question 1, 2, 3, and then instead of saying question 2, it's just going to go and say question 4, 5. Okay, not question 2, B, C. So in the physical exam, it'll look like this. The physical exam, it'll look like this. So it'll be question 1, and it'll be A, for example, A, B, C. And then you'll have question 2, and it'll be A, B. And then you get question 3, which might just be might just be A. So the way it works in the online, it'll just be question 1, question 2, sorry. So this will be question 1, this will be question 2, this will be question 3, this will be question 4, this will be question 5, just so you don't get confused. This will be question 6. Okay, that's how it goes.
But at least it's in order, it's not like scrambled.
No, it's in order. No, it's in order.
But then, before I continue, so that because there's an option to be given like a physical paper where one could write instead of going online. For people that can make it to those venues, like some of us that can make it to campus,
Yeah.
why can't we be given like physical paper too? It's not possible on the day to be given like physical.
Well, I'm sure you will be able to do a physical exam.
Then you don't have to worry about Wi-Fi.
Yeah. No, I'm sure you can. I'm sure that's why they're inviting you onto the campus. Sure, you can write a physical. Okay, so question 1 is, if you're writing the physical, question 1, or the first few questions in the online are about the nature and scope of real estate investment. The nature and scope of real estate investment. That's question 1. And question 1 is for 10 marks. And there's some subsections there. And go and have a look at some of the details there. Everything comes out of the notes. There is nothing that comes from anywhere other than the notes. Okay, everything comes from the notes. Go and have a look there. There are a couple of characteristics that are quite important. Go and read them and go and make sure you understand them and can explain them. Okay. There's also a framework there that's quite important to know too. Go and have a look at that as well. Question 2, which would be the next bunch of questions on the online. In fact, it's the next question. It's capital budgeting. That's the net present value. Now, this is the most important question in the whole paper. It's worth 15 marks. And please, go and review this thing. And make sure you can do this thing on your own. Take the question and go like this and see if you can do the answer. Okay. Make sure you can do this. This is 15 marks. This is 30% of the paper. And you're going to get examined on this at the end of the year as well. It's going to be one of the questions at the end of the year. It's the most important part of this course is understanding capital budgeting. Okay. So make sure you can do this thing. It's on Blackboard. Part of the notes, it's sitting there. Okay, you must be able to do this thing. You're getting a question like this. No, 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 no. No, you're not going to get that. No. No, you're only going to get something like this. No. Those are there just so that you understand there are other ways of valuing properties. Okay. So, yeah, and know how to do this and understand this thing about the discount factor. The discount factor is really just the result of a calculation. We don't want you to do we don't want you to do this calculation in the exam. We don't want you to do that calculation. That's hectic. You know, some guys haven't got hectic calculators, so it puts you under a lot of pressure. We've done that calculation for you, and we've given you what we call a discount factor. Okay. So just know how to use that discount factor, because that's what you're going to get. Okay. Otherwise, it's straightforward. If you follow this and do it a couple of times, because it's 15 marks. Each net present value, there'll be 2 properties. Each net present value 6 marks, and then the final. Remember, you must answer the final question. That's 3 marks. The question is, which building would you choose? You must say which building you'll choose, and you must say why. Okay, and it's because the net present value of the one is higher than the other one. Okay, so you choose the one with a higher net present value. If you don't answer the question, you don't get the 3 marks. Okay, it's very important. So that's question. Well, it's question 2 in the physical. It's one of the questions a little bit further down in the. So you must be able to do that. 15 marks. Question 3, or one of the next question in the online investment strategy we did today. And what is important in investment strategy? You tell me. That investment analysis process, very important. Have a look at it, understand it. Have a look at a few of the other things, but concentrate on that. Understand it, know the process, and make sure you can describe the steps. That's only 5 marks. Okay, it's a very small section. And then ownership entity is the next, it's question 4 in the physical. There are 3 subsections there. And if I can give you a hint, go and spend some time on those real estate investment trusts. Understand them, know their benefits, what they're there for, who they're there for, how they're structured. Remember those risks that I mentioned. Have a look at the benefits. You'll have to fish around for the benefits. It means reading the whole thing to try and get all the benefits together. There are a lot of benefits, like the diversification, the professional management. There are a whole lot. Go and have a look at them all. Okay. It's ownership entity. And then the 5th question has got a couple of, it's got 5 sub-questions. So it's just the next one further down is on tax. And I tell you to go and concentrate on capital gains and transfer duties. Know how to do one of these examples we did up here, okay, from a table if you're given one, and go and understand fully capital gains tax and those effective rates of the different entities. Question 4 is for 10 marks. Ownership entities, 10 marks. And tax is also 10 marks. And with your multiple choice test, it started some of the process of preparing yourself. Because in that test you had to go through your notes. It forced you to go through the notes. It was half the reason why we had the test the way it was. Open book and covered the full semester. Well, not quite. We didn't cover tax, did we? But you at least now are familiar with the different parts of your notes, and now you need to go and spend some time study a little bit. And if you think about it, you've got 5 sections here. You've got about, how many days? You've probably got 15 days or more left. Is it more? It's 3 weeks. Anyway, divide your time, into those couple of weeks, and try and do a question every couple of days, or a unit every couple of days. So you don't leave it to the last minute. Okay. Any questions? And it's not a hectic test, eh? The other thing is, I would advise you to sit the full 2 hours. You've done 4 months or 3 months of work, and to walk out after, and you're given 2 hours within which to prove yourself. To walk out before time is up is actually a silly thing, because you might be able to get a couple of extra marks here or there. You must go through your work again, make sure you've done the right thing. And if you get a question you don't really know what to write down, write something. Don't write nothing. Nothing gives you naught. Something might give you 1 or 2. Just write something. Normally examiners look at it and they just because you've applied your mind a little bit, they'll give you a mark or 2. Okay. But try and sit the full 2 hours. It's not a long exam. Okay, guys. Thank you.